If you keep up with the news, I'm sure you've heard of the significant rate cut by the Federal Reserve a couple weeks ago. So, what is the relationship between that rate cut and mortgage interest rates? Let me highlight a common misconception in our industry. When the Fed, that's the Federal Reserve, announces a rate cut, many people think that mortgage rates will also get cut right away. But there's really very little correlation between the two, and this is why. The Federal Reserve controls the federal funds rate, which is the interest rate banks charge each other for overnight loans. This primarily influences short-term rates like credit cards and auto loans. This does not impact long-term rates like mortgages. Mortgage rates, on the other hand, follow the bond market and are more closely tied to the 10-year Treasury yield. So when investors are nervous about the economy, they often move money into safer investments like bonds, which can lower the yield and in turn lowers mortgage rates. This can happen regardless of what the Federal Reserve has going on. So what really impacts mortgage rates? I'm glad you asked. Inflation is one, economic growth, and global events. If inflation is expected to rise, mortgage rates tend to go up regardless of the Fed's actions. So even if the Fed's cut rates, mortgage rates might stay the same or they could even increase. That said, mortgage rates are currently the lowest they have been for over a year. So reach out if you'd like to learn more about potentially buying or selling or to be connected to a great lender. We're here to help you navigate these very confusing waters.